You're entering the future-ready CNBC TV 18 eBix Cash Studio.
Hello and welcome to CNBC TV 18 eBix Cash Studio. You're watching Commodity Champions and I'm Manisha Gupta. Today we're discussing the possibility of a widespread global fuel shortage that has pushed crude oil prices above the $80 per barrel mark for the first time in 3 years. This spike in prices comes amid a broad rally in energy markets with growing competition between Europe and China driving gas prices to record levels in recent weeks. The low supply from the United States, where inventories are at a 3-year lows following the impact of Hurricane Ida, has pronounced a shortfall in global gas production as well. This, along with concerned drive in China to cut down on pollution from heavy industry, is expected to push crude higher as industries shift to using oil to generate power. However, demand continues to grow despite supply constraints, with winter in the northern hemisphere increasing the need for crude oil, natural gas, heating oil. The ease of COVID restrictions worldwide has only multiplied this need of making a further spike in prices all. But inevitable, with China already releasing 4.4 million barrels from reserves and OPEC to meet soon, can these supply hitches be eased out in time to keep up with the rising demand? And how high can the crude oil prices rise in the near future? Joining me now to take the discussion forward is Paul Hicken. He's Associate Director, Oil at S&P Global Platts. David Lennox is Analyst at Fat Profits. Many thank you, gentlemen, for joining us on CNBC TV 18. Let's start with the crude rise itself first. And Paul, this question is to you. $80 is here, with many Wall Street banks now telling us that $90, $95 in this year and $100 a barrel in next year is a possibility. First view on prices itself.
I think, first of all, you look at where the rallies come from partly, and it was very slow. The disruptions that happened from the Hurricane Ida and the way that US get back on track has been a lot slower than expected, and that has been the first mover. The fears about the switching from gas to oil is what it is, really, a fear at the moment. There is a little bit going on, but how much is that going to translate into actual buying of extra crude? It's slightly market psychology at the moment. And if you think about what happened in, for example, the UK, the little bit of the panic buying over petrol when there wasn't really a shortage, it's a little bit like that in the psychology of the market, thinking it's probably tighter than what it is. Yes, the market is tighter. Yes, crude stocks are coming down significantly in the US, and that's a big barometer for oil prices and where they're going. But at the same time, there's a lot of oil still swashing around, and China holds a lot in reserve that we've seen them already act small, and OPEC Plus has a significant amount of spare capacity, Saudi Arabia and Russia in particular. But you've got to remember that just a couple of months ago, we had the disruptions at OPEC talking about extra quotas because they wanted to be able to produce more. So, and they meet monthly. So they must be itching to address the issue if prices continue to go further, and this momentum in the market that seems to push through 80 continues.
Well, absolutely. That point is well taken, that there are inventories globally, and too, OPEC has enough and more spare capacity. But that doesn't really seem to be helping the crude prices come off these recent highs. So, Paul, are there any price forecasts that you are putting out?
I think at the moment, we're still looking for fourth quarter that it's likely to be around the $70 a barrel mark still for now. I think there is that momentum. There is a lot of volatility in the market, but you've got to take a little bit of context of how high the prices go until you see action from China, until you see action from OPEC Plus, more than they're already going to bring on. The reason they're moving every month now, they move to these monthly meetings, is to react and adapt to short-term volatility in the market, especially from COVID, especially since what we haven't really talked about, which is demand, and demand has been improving as well. You had the shadow of Evergrande hanging over demand to some degree, and some other concerns about China buying a month or so ago. They seem to be put on to the sidelines for now, as demand seems to be fairly back on track, and these, like you said, these cross-commodity supply concerns, and not just in oil, but across the gas market, across coal in China as well. And it's feeding into a little bit of concern and fear into the market generally.
David, for the last 12 or 18 months, all that we spoke about was electrical vehicles, energy transition, solar panels, etc. And then when you look at the conventional fuel prices, those have continued to surge. Crude is the one part of it. It's trading at a 3-year highs. You have natural gas, 7-year highs. Coal, as Paul mentioned, at all-time highs. So while the demand, EV is a number, EV is a forecast and a target, but on ground, the demand for these conventional fuels is still high, would you say?
Yes, the conventional energy sources are still in high demand, primarily because if you have a look at the energy supply, at this point in time, there's really no green or carbon-free energy sources that could cope with the rises that we're seeing in demand for power and energy across the globe right at this very moment. If they could, then we wouldn't certainly be seeing the very high coal prices or the oil prices or the gas prices. So really it is that lack of ability of carbonless energy to actually compete with and deliver significant amounts of power. That's why we are seeing these high carbon energy prices right at this moment. And it's probably likely to persist for some time. It does take a while to actually get the base ability of carbonless sources of energy to actually come up to the same type of ability that we've seen in carbon energy for some time.
So, David, there are various reports suggesting on how the global crude demand will peak out in 2030. There are some others saying 2040. What is your sense, and how are we looking at the crude demand for next year now?
Look, certainly we're looking at probably a smidgen over 100 million barrels of oil a day demand going through into 2022. We do expect that the global economy will be a little more normalised as COVID, although still with us, tends to recede towards the background. And once that happens and we do get a reasonably well vaccinated world, we're then going to see the obligations of travel worldwide rather than just statewide. And that's going to add another dimension to demand for energy. So look, overall at this point in time, we think about probably somewhere about 100 million barrels in 2022. Probably at this point in time, slightly under that for this year, but we certainly do believe that the demand is rising. But we've also got a price at the moment of between $75 and $70 for Brent. So you can see it's broken through well through the top end of our price. But as Paul suggested, there's still a lot of latent supply that just hasn't come back on stream. Even inside the US, there's well over 1 million barrels that can come back. So once we see those prices probably start to move towards 90, we think that's going to see a lot of latent production coming back on stream.
All right. Another point that I want to really discuss about is the consuming countries like India. So, Paul, this one is to you. We import 87% of our crude requirement, and our petrol and diesel prices already are trading at an all-time highs here. What is your sense? And when it's not just crude, it's not just fuel, because it starts to trickle down to fertilizers, rubber, paints, various other industries as well, and in the food products also. So what are we readying ourselves for right now?
Well, I think it's certainly a nervous time for the key producers, countries like India, countries like China. And I think you may see more vocal comments from leaders from the big consuming countries as we approach the meeting for OPEC Plus. So that is one to watch out for. And we've seen it before. The Biden administration had some soft comments for OPEC Plus as well. And this is certainly politically, certainly we talk about inflation coming back at a time when global economic recovery is still fairly fragile. And then we're adding to this commodity price inflation into the mix. What's this say for interest rates? And I'm not a macroeconomist, but this is certainly what the market's talking about. And that feeds into the questions about how much of a cap does this act on demand as well. So there's a lot of aspects in the mix to this to the concern from the consuming side.
Oh, well, you absolutely touched the nerve there when you talked about the interest rates. Yes, that is a debate that is heating up right now. David, another thing is about the investment itself. When you look at 2019, I understand that the global crude investments were at around $600 billion. Come to 2020, and that got down to $350 billion. Clearly, last year was a year that we did not see much investments or expansions for that matter. But this year also doesn't seem likely that we are looking at any uptick in that sector in sense of investments. Is that a concern going forward?
Oh, look, yes, that will be a concern until such time as we can see carbonless energy sources starting to take up that slack. The reason we haven't seen a significant amount of investment, because it does take a lot of money to actually get a new field up and running. And if you're looking out to the broader horizon, beyond, say, 10 to 20 years, you may find yourself not being able to recover the full cost of what you've developed over the course of the balance of its life. So investors are being very, very cagey as to how they go about investing in the oil sector at the moment. We've seen a lot of merger activity going on, so they're actually buying existing fields rather than developing new. So we may expect to see that continue, especially as the oil companies are somewhat cashed up. So we think that's the avenue that they'll take. It's less costly and they can bring production to stream a lot quicker. So you wouldn't want to be developing a 16 or $17 billion field and hope that in 25 years you're still getting good returns out of it. You may not necessarily be doing that. So they're being very cautious as to putting new money in. And of course, lack of new money, lack of investment, lack of new supply coming on, demand is always there, and that will keep pressure on the demand side.
Absolutely. So, Paul, and it's not just about crude, because look at the natural gas prices, and the world last year was talking about hydrocarbons and the gas mix to usage, and we've seen the natural gas prices run on back of that and supply concerns also. Heating oil, gasoline prices, we see those pictures coming out of UK where there is almost a crisis now about gasoline availability and prices itself. How do you look at that scenario? Is that a concern right now for you?
Yeah, and I think what's the key thing is what to touch on what David said, which is investment in hydrocarbons, which is there's a lot of oil and gas investment goes hand in hand as well, and there is a real reluctance to invest in long cycle, long investment projects. And yes, there are a change of hands, which could mean that smaller independent players still have the appetite to invest in some of the bigger projects, because the oil majors are certainly turning their backs on them. And with concerns around ESG and meeting certain guidelines and certain commitments around environmental goals, then that is an issue. But at the same time, if we're looking at 2022, and there are lots of investment risks, you've also got to remember that shale, we've forgotten to talk about US shale, the marginal producer, it's down in the dumps. It's been plateauing for some time, but there is life in US shale still, and it was at 13 million barrels a day before COVID, and it's down 2 million barrels shy of that. And there is certainly there's certainly a good case to be made that they will be back, and be back in 2022 in some way. And if prices stay this high, then money talks, and the appetite for investing back in shale will be there. And OPEC plus, Iran, who we haven't talked about, still no deal at the moment. Still potentially a 1.5 million barrels a day of Iranian crude could come on by the end of 2022 if a deal happens soonish. And yes, that's still up in the air, but there's certainly supply that could well come on and change the game in 2022, especially where price is staying high.
Oh, well, absolutely. There's just so much to watch out for. Never a dull day, especially in this sector. But on that note, let's go for a short break. But don't go anywhere, because on the other side, the discussion continues when we return.